What if the number displayed as silver's price on every screen in America tonight is not just wrong, but a carefully maintained fiction that the physical world has already begun to violently detonate? History has an inconvenient habit of issuing its most consequential warnings in formats that most people mistake for background noise. In warehouse receipts, delivery notices, and vault inventory reports that arrive quietly and are promptly disregarded by a financial press better suited to narrating the obvious than detecting the structural. What is occurring right now inside the global silver market is precisely that kind of warning. Not a rumor, not the speculative fever of a fringe newsletter. Arithmetic, cold, public, and verifiable, being published daily by the exchange itself, absorbed by virtually no one outside the thin layer of professional traders whose livelihoods depend on understanding it before the rest of the world catches up. Begin with the numbers that the institutional financial press has chosen, with remarkable consistency, not to examine. In the first 4 trading days of December 2025, more than 60% of COMEX registered silver inventory was claimed for physical delivery. 60%, 47.6 million ounces, removed from exchange vaults in fewer than 5 trading sessions. December 2025 went on to generate 65 million ounces in total physical silver deliveries, a single-month record in the exchange's entire history. January 2026 followed with 49.4 million ounces, a figure 7 times greater than January 2024's deliveries. All of 2025 combined settled 474 million ounces of physical silver against 203 million in the year prior. In a single calendar year, without any single named catalyst that the mainstream financial media was willing to acknowledge or examine, the rate at which real, tangible, industrial-grade silver was being removed from COMEX vaults more than doubled. These are not the statistics of a market experiencing mild friction. They are the diagnostic readings of a system operating under cumulative structural pressure that did not emerge overnight and will not resolve with a margin adjustment or a regulatory announcement. And yet silver trades today, near $66 per ounce on COMEX, down roughly 45% from its all-time nominal high of $121.62, reached on January 29th of this year, a price that most casual observers interpret as evidence of a failed rally, rather than as the outcome of an exchange's emergency intervention in its own market. Before we go further, where are you watching this from tonight? Drop your country, your city in the comments right now. We want to know how far this story has already traveled, because what we are going to lay out in the minutes ahead tends to find its most attentive audiences in places where the physical silver market is not an abstraction, where it is felt. On February 11th, 2026, COMEX registered silver, the specific, formally warranted pool of metal legally designated for delivery against futures contracts, fell below the 100 million ounce threshold for the first time in recent institutional memory. The exchange reported a single-day negative adjustment of 3.256 million ounces in the registered category, while vaults simultaneously recorded withdrawals of more than 4.7 million ounces from eligible silver in the same 24-hour window. These are not the numbers of a market in equilibrium. They are the numbers of a market in which the load-bearing wall between paper claims and physical reality is thinning at a rate that the paper price has not yet been permitted to acknowledge. Today, COMEX registered silver sits at approximately 82 million ounces. Positioned against that inventory are 196.8 million ounces of open interest in the July delivery month alone, 39,356 contracts, with first notice day 6 business days away. The coverage ratio, the percentage of outstanding paper claims against which the exchange could theoretically deliver actual metal, stands at approximately 15.8%. COMEX's own methodology defines anything below 15% as stress territory. We are, as of this writing, one standard deviation from the exchange's own definition of a market under duress. One standard deviation, and the July delivery clock is already running. That 16% figure is not abstract. It represents the distance between the architecture of COMEX's paper-silver market and the physical world that the exchange was designed, decades ago, to faithfully represent. For the better part of the exchange's history, that distance did not matter, because the fundamental operating assumption of all leveraged futures markets held with sufficient reliability to make the implicit leverage invisible to most participants. That the overwhelming majority of contract holders would roll their positions forward, take cash settlement, or exit without ever demanding actual delivery. The model worked because most participants wanted financial exposure, not warehoused silver bars. In 2025, without a single dramatic announcement, that assumption began, quietly and with gathering persistence, to fracture. The fracture did not announce itself. It manifested in warehouse receipts. It appeared in daily vault reports that anyone with a COMEX account number and 5 minutes of patience could access and read. It expressed itself in delivery notice volumes that had no historical precedent in the exchange's data. And it set the stage for a price divergence that is, right now, the most structurally important signal in the global commodity markets. One that the $66 paper price on your screen is actively obscuring rather than reflecting, and one that the physical market in Shanghai has been pricing with brutal accuracy for the better part of 2 years. There is a sentence that almost never appears in mainstream financial analysis, despite the fact that it is supported by official exchange data, verified vault reports, and the publicly stated delivery specifications of two of the world's most consequential commodity exchanges. That sentence is this: COMEX and the Shanghai Futures Exchange are no longer operating in the same market, not because of geography, not because of currency, but because of purity, and the implications of that single technical distinction are rewriting the global price discovery mechanism for silver in ways that most American retail investors have not begun to comprehend. COMEX standard silver is 99.9% pure. The Shanghai Futures Exchange requires 99.99% pure silver, one additional decimal place that, to the untrained eye, reads as a marginal refinement scarcely worth noting. To a Chinese solar panel manufacturer operating under production specifications set by the engineering requirements of high-efficiency photovoltaics, that decimal point is the difference between metal that functions and metal that does not. To a semiconductor fabrication plant operating at the frontier of material science, it is the difference between yield rates that sustain a business and contamination rates that destroy one. To the electric vehicle battery assembler attempting to meet production targets set by state industrial policy, it is a specification that admits no negotiation and no compromise. The consequence of this purity split is not merely technical, it is structural and permanent. Chinese industrial buyers, representing collectively the world's largest industrial silver market, require the 4/9 grade metal that the Shanghai Exchange delivers. They cannot substitute COMEX grade silver in their highest specification manufacturing processes. They cannot petition their procurement departments to modify engineering tolerances because the paper futures market in New York happens to quote a price they find attractive. They pay whatever Shanghai asks, because the alternative is not manufacturing. The Shanghai Gold Exchange benchmark is currently trading at approximately 10 to 11% above the equivalent US dollar COMEX price, a premium that was sitting near 18% only weeks ago, before the Federal Reserve's hawkish June meeting temporarily suppressed physical demand expectations, and which is now climbing steadily back as Chinese industrial buyers re-engage at current price levels. That premium, seemingly modest in its present form, carries enormous historical freight. In December 2025, the Shanghai Gold Exchange benchmark settled at approximately $78 to $79 per ounce, against COMEX prices near $72, a premium of 8 to 10%. Within 5 weeks of that premium signal, silver reached its all-time nominal high of $121.62 on January 29th. The Shanghai premium was not the lagging indicator in that sequence. It was the leading one. The physical market moved first, because physical buyers cannot defer their industrial requirements the way a Chicago hedge fund can defer a paper position. The solar panel factory does not roll its silver requirements forward to the next delivery quarter. The semiconductor fabrication plant cannot accept a cash settlement in lieu of 4/9 grade metal. They need the silver at the purity they require and the volume they require delivered to their facility, or their production lines stop. Now, if this analysis is giving you a structural framework that you did not have before you started watching, I am going to ask you something directly. Hit the subscribe button right now, not because we will tell you to buy silver or sell silver or do anything particular with your money, but because what we are building in this series, the kind of analysis that connects COMEX vault mechanics to Shanghai purity specifications to China's export control architecture, is analysis that the mainstream financial press is neither equipped to produce nor incentivized to publish. The next chapter of this story is going to move faster than most investors expect. Subscribe now, then stay with us, because we are not finished. When you add China's 13% value-added tax on silver imports to the current exchange premium, plus insurance, logistics, and financing costs, the true all-in landed cost of silver for a Chinese industrial buyer sourcing from international supply is not 10 or 11% above the COMEX quoted price. It is closer to 25 to 30% above it. The $66 COMEX quote is not the price of silver in the world's largest industrial silver market. It is the price of a derivative contract in New York. The gap between those two realities has been building for more than 18 months, and its persistence is not a trading anomaly awaiting rapid correction. It is a structural divergence rooted in purity specifications, regulatory restrictions, and industrial demand that is growing faster than the supply chain can expand. China's January 2026 export control framework, largely unreported by Western financial media at the time of its enactment, restricts 60 to 70% of globally refined silver supply to a narrow set of 44 licensed companies, meeting minimum production thresholds of 80 metric tons annually and $30 million credit lines. China refines a dominant share of the world's newly mined silver. That regulatory architecture effectively transformed China from a participant in the global silver supply chain into a gravitational force, pulling physical metal toward its domestic market through premium pricing, while restricting outward flows through licensing requirements that most international suppliers cannot meet. The arbitrage mechanism that would historically have closed the Shanghai COMEX price gap, the free movement of silver from lower premium to higher premium markets, now faces regulatory friction that prevents it from fully functioning, and that friction is a deliberate instrument of national industrial policy rather than an administrative oversight awaiting correction. Add to this the trajectory of Shanghai Exchange warehouse inventories, which have been declining steadily even as industrial demand climbs, a combination that in any commodity market carries a singular interpretation. Demand is outpacing supply at the margin. And then consider the Sprott Physical Silver Trust, which doubled its capital raise program to $2 billion in January 2026, representing the capacity to purchase approximately 18 million ounces of physical silver, roughly 22% of COMEX's current entire registered inventory, in a single institutional transaction. Sprott does not fabricate solar panels. It removes physical metal from the accessible pool of Western commodity markets and places it in allocated, ring-fenced storage from which it does not return. Behind it stand corporate treasury departments treating physical silver as supply chain security, pension funds implementing diversification mandates requiring allocated physical holdings, and cross-border arbitrage operators exploiting the mathematical gap between the COMEX paper price and the premium that physical 4-9 silver commands the moment it clears customs in Shanghai. Each of those actors has independent motivation. None of them is waiting for the others. And their combined simultaneous drain on COMEX registered inventory is the 16% coverage ratio that the exchange's own public data reports today. It would be a mistake, an analytical error of the first order, to characterize COMEX as a passive victim of forces it cannot comprehend or address. The exchange has tools, and when silver surged past $100 per ounce in the extraordinary opening weeks of January 2026, it deployed them with precision and measurable effect. The CME Group, COMEX's parent organization, raised margin requirements dramatically in the immediate aftermath of silver's approach to its all-time high. The mechanism was transparent, and the result was textbook in its predictability. Margin calls compelled leveraged long position holders to either deposit substantially more capital or liquidate their positions under duress. The cascade of forced selling that followed contributed directly and significantly to silver's retreat from its January 29th peak of $121.62 to the $65 to $67 range in which it currently trades, a decline of approximately 45% from the historic high. This is not a scandal, nor is it a conspiracy. It is the legitimate exercise of an exchange's authority to manage systemic risk in a leveraged derivatives market, an authority that has existed in commodity market regulation since the 1920s, and that has been invoked, with varying degrees of controversy, in every significant commodity squeeze in the exchange's history. What is more instructive than the outcome, however, is what the margin adjustment demonstrably did not accomplish. The paper price was reduced. The Shanghai premium did not narrow in proportional response. COMEX registered inventory did not recover to levels that would provide meaningful coverage against outstanding open interest. China's January 2026 export control framework did not retract. The 474 million ounces of physical silver that departed COMEX vaults during 2025 did not return to the registered pool that now sits at 82 million ounces against 196.8 million ounces of July open interest. The paper mechanism performed its designed function. The physical reality declined to participate in the correction. There exists a more extreme instrument in the exchange's regulatory armory, the provision sometimes described as the emergency liquidation only rule, invoked during the Hunt Brothers Silver Corner of 1980, which effectively converted COMEX into a market that refused to accept new long positions under conditions of extreme delivery stress. The invocation of that provision in 1980 succeeded in breaking the market's momentum by eliminating the speculative demand that was animating the squeeze. The Hunts were manufacturing demand through financial leverage. Remove the leverage mechanism, and the manufactured demand evaporated. The distinction that separates 1980 from the present structural situation is, frankly, the entire analysis. The demand that is driving silver out of Western vaults today is being manufactured not in a trading room, but on assembly lines in Shenzhen, in Chengdu, in Guangzhou, by industrial processes that produce the solar panels, electric vehicles, and semiconductor components upon which China's economic output depends. No change in COMEX market rules can alter the engineering specifications that require 4/9 silver. No emergency regulatory provision can reduce China's installed solar manufacturing capacity. No margin requirement restructuring can reverse the export control framework that restricts domestic refined silver from leaving the country. COMEX will not formally default. The clearinghouse mechanisms, the cash settlement provisions embedded in contract terms, and the regulatory infrastructure surrounding CME Group are designed precisely to prevent a clean, public, named default from occurring. The exchange has the legal and operational capacity to manage extreme delivery stress without that stress being characterized publicly as institutional failure. What the exchange is structurally incapable of preventing, through margin adjustments, emergency rule changes, or any available combination of the above, is the steady, systematic, motivation-diverse drain of physical metal from its registered inventory pool. That drain proceeds simultaneously through independent channels, industrial demand pulling 4/9 silver toward Shanghai at whatever premium is required, investment mandates from institutions removing metal into allocated long-term storage that the futures market cannot access, and arbitrage operators exploiting the mathematical gap between a $66 paper price in New York and the premium available the moment that same metal arrives in China. The institutional price targets that have emerged from professional analysis of this situation are themselves worth examining, not because targets possess oracular authority, but because of who is publishing them, and the structural assumptions necessarily embedded within them. Commerzbank maintains a $90 per ounce year-end target. J.P. Morgan's commodity research team projects $85 in the fourth quarter of 2026. The Reuters Analyst Consensus Survey produces a figure near $79.50. These projections do not emerge from newsletter writers or speculative precious metals enthusiasts. They emerge from institutions that manage hundreds of billions of dollars in assets, employ quantitative analysts of the highest caliber, and face professional and reputational consequences for material errors in their published research. And every single one of those targets is predicated on a single structural assumption, stated or implied with varying degrees of directness, that the physical market will eventually compel the paper market to reflect its reality. That is not a silverbug's daydream. It is the consensus published opinion of the largest commodity research departments in institutional finance. The assumption has extensive and reliable historical basis. It is, in fact, the primary mechanism by which commodity markets correct when paper pricing diverges from physical supply and demand reality for a sustained period. The paper market can maintain a state of divergence for months, as it has throughout the present episode, but the arbitrage mathematics of physical delivery eventually assert themselves with a force proportional to the size and duration of the accumulated divergence. An entity capable of executing international vault-to-vault transfers can, in principle, withdraw silver from COMEX at $66, transport it to Shanghai, and realize a premium of 10 to 11% above that price the moment it arrives. And that arithmetic becomes increasingly compelling the longer the premium persists and the closer it climbs toward the heights that preceded silver's January ascent. The gap closes in one of two directions. Either Shanghai prices fall to meet the COMEX paper price, which would require a structural contraction in Chinese industrial demand that no published data currently supports, or COMEX paper prices rise toward the physical reality that Shanghai is pricing in, which is precisely what the institutional consensus targets of $79, $85, and $90 are forecasting, with varying degrees of confidence and varying time horizons. The silver price on your screen tonight, $66, is the price of a paper contract in New York. The acquisition cost of industrial-grade silver in the world's largest silver-consuming economy is materially higher. The official COMEX vault reports, the Shanghai Gold Exchange benchmark data, the Silver Institute's cumulative supply deficit figures, the institutional delivery pattern records, and the cross-border flow data are not separate stories. They are the same structural story expressed through different measurement instruments, each of them documenting a divergence between paper claims and physical reality that has one historically established resolution, and only one. History does not always arrive with headlines. Sometimes its most consequential developments arrive in vault inventory reports and delivery notice data, quietly and without ceremony, in the background of an ordinary trading week, until the accumulated weight of arithmetic becomes impossible for even the most incurious observer to ignore. The question worth sitting with tonight, in whatever corner of the world you are watching from, is not whether the gap between paper-silver pricing and physical market reality will eventually close. That question carries a well-established answer. The question is whether you understood the mechanism clearly before the announcement arrived. If this analysis has given you a framework you needed, drop your most pressing question about silver in the comments right now. Whether it concerns COMEX vault mechanics, the Shanghai premium recovery, the purity differential between exchanges, China's export control architecture, or how the institutional targets of $79, $85, and $90 were constructed, leave it below. We read every single one. The most important and most frequently asked questions become the foundation of the next video in this series, and the analysis deepens in direct proportion to the quality of the questions the audience brings. The audience watching this is, demonstrably, bringing excellent questions. Leave yours below. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.